Session. Moving on now to some chartology. Rally fizzled a bit today. The hopes for a 5-day rally dashed in the final 15 minutes or so of trade. So we bring in Jeff DeGraff to tell us and decipher the charts for us whether or not this bear market bounce is actually over. And what are you watching, Jeff?
Well, there's a couple things. The first is we're coming off of a very deep oversold condition. So historically, we think we're set up for one of the biggest bear market bounces that we've seen, certainly in this cycle, probably over the last 100 years, one of the bigger bear market bounces we're going to see.
When you say bigger bear market bounce, how long is that? We had Jeff saw it, I think it was Friday on Fast Money, saying, you know, typically it could be three weeks or so.
Well, actually, the average bear market bounce for the last 100 years is 46 trading days. It's about 2 months. So if we're looking at extending that duration, we think we're probably in pretty good shape through or to Memorial Day. So I think the spring is going to be a decent time for equities as we go forward. One of the keys, though, as we climb, is to look at the percentage of issues above their own 50-day moving average. This historically has gotten into about 80%, at which point, as long as the overall trend of the market's still down, it's a point where we start to pull the ripcord and back out and start reasserting the bear trend and getting short again. Okay,
and you also look at advanced decline ratio, and that seems to be signaling positive.
That's the big thing right here. You had an advanced decline ratio. You can see way over here a cluster. You had Tuesday, and when I was on the show, that was a great kickoff day, and then you confirmed with it on Thursday. To look at that sequence, you have to go all the way back to August of 1982 to see something even similar to that. Now, that was the beginning of the huge bull run. We're not calling that. But if you get a cluster like we have here, it's very, very hard to unwind that in a short period of time. So we think it's a consolidation. We move higher. We get that previous chart that I showed you back above that 80% zone, and then we're going to start looking at the bear case.
And just to be clear to the viewers at home, we're looking at the NYSE 80 line with the S&P 500 above it.
Correct. So this is the advanced decline ratio. So there are 20 net advancers at the top of the scale.
Okay. And the sectors you like here, information technology and tech has really been a leader for quite some time coming out of this bear low, I guess.
Correct. So what you can see here is that the breadth of tech has actually failed to make a new low. So even as the market was, or the technology specifically, was going down and retesting those lows of the fall, the breadth line was far firmer, which said internally things were a lot better than what you're seeing just by the price action. And that's a good positive divergence that was setting itself up for tech.
Within technology, do you take a look at the semiconductor index in particular in terms of a leader of the markets? Because we had another technical analyst on last week saying that is the index that you watch.
Yeah, I don't know if it's the index. I mean, it's one to watch. It's certainly doing all right. But you know, as far as being the index, we don't look at it that way. We think tech overall looks better than any one particular index within that.
Okay. And you also like healthcare.
Healthcare is interesting because, again, the breadth line is holding up. The big farmers aren't that strong, and obviously there's a lot of takeover activity, but you look at equipment names, you look at suppliers, and you'd think it has a more defensive tone, but it's actually acted very, very well off the lows in November and still holding up very well in this strength, which is a good sign. Most people think, well, if the market's going to be strong, healthcare is going to fade because it's got a defensive quality to it. That really hasn't been the case here. So I think healthcare might surprise for 2009 as a pretty decent place to be.
Okay, guys on the desk, what do you make of healthcare given all the political machinations going on in the sector?
Well, I mean, the biotechs got beat up on some of this Obama rhetoric that's coming out. I think a lot of them are valued. Celgene, more and more analysts write about the positive news in Celgene. Getting back to what Jeff was talking about in terms of the market internals, I agree. Tuesday was not your usual rally that we've seen throughout these bear markets. The internals were tremendous, and I really believe it's setting us up for a move to 900 in the S&P. I think the duration of the rally would be shorter because I think things happen quicker now, but I agree with what a lot of stuff Jeff just said.
Jeff, if you would for a second, go back to the 50-day moving average conversation that you're having, because if you look at JP Morgan, got above the 50-day today, look at Goldman Sachs, got above the 100-day moving average today, and Morgan Stanley for a minute got above the 200-day moving average. So how do I interpret that? Do I become a seller above those levels, or over the next couple of weeks, do I want to see it sustain? What's the relationship there? Well,
so right now with those stocks above those key moving averages, they actually become leadership names, and they're on our leadership group. And we look at individual names. Those names are actually part of our top 25 that we look at because they represent leadership. When the overall market gets to that percentage above the 50, that's where it becomes more of an issue. So I would be a seller of those when the overall market, the percentage of issues above the 50-day hits that 80% zone. But right here, I'm staying with those because those are horses. Those are leading us higher.
Got to leave it there. Jeff DeGraff, ISI, thanks so much for that chartology. You want to go straight